Alrighty, sisters and brothers of Finance 300. This is week 2 case study review. I won't do much of anything on this except for walk you through the information that you have and what you need to do. So let's get started. You have the income statement for a particular company, Maria's Soup Shack. Try to say that really fast. And it's already has information plugged into it. And curious enough, it has some formulas already in here, right? So if you've been struggling with how to calculate gross margin, you might find it here, right? Total cost of goods includes in here. Your labor, wow, it even has a formula in here for the actual how it calculates payroll tax. And it has it in here for EBIT, and it has it in for EBT, and even the tax calculation. So if for some reason you're finding the prior assignments a little difficult, you might be able to go back and redo them based on what you see here, right? They've got all these numbers in here and they have them referenced and they have the formulas there to refer to. They even have the formulas in here for the balance sheet as of a particular date, right? You have your total current assets, your fixed assets, your total asset number, exactly the same as we saw before, with some obvious changes to the actual numbers, but the calculations are there for your reference. Now, you are asked to calculate all these metrics and determine whether or not it's good or bad, or actually, if it's improving, if it's the same, or if it's worse. Okay. Now it's telling you, wow, interesting, only include the variable portion of COGS in this calculation. Compute as gross margin versus gross sales. Now it's giving you some notes, some clues on here, right? So the gross margin is pretty easy. This one we already know, right? The current ratio is on the other assignment that we did, so I will not go over that. Current debt to equity is already there. Leverage is there. Return on sales, which is the profit margin or EBIT, or earning net income as a percent of revenue. That's what that is, which we already covered as well. We covered return on assets, we covered return on equity. We covered how to calculate working capital and working capital days. We also calculated days sales outstanding, days inventory outstanding, and days payable outstanding. So the tricky part is if these are improving, if they're the same, or if they're worse. Typically, unless they're exactly the same number, right, it's either improving or worse. And that you should be able to find out pretty easily by reading the text on what is better or worse. Now, usually it returns, obviously, higher the number, the better than a lower number. On days sales outstanding, usually a lower number is better than a higher number. Same with days inventory outstanding. Usually a lower number is better than a higher number because a lower number means you have smaller investment in inventory. Same with purchasing days purchasing. Arguably, DPO is just the opposite because it's a liability. The higher the number could be better than the lower number, but at the same time, because it's associated with your vendors, your suppliers, higher numbers aren't always the best because then you have troubles with your suppliers. So that one's a little tricky, but arguably higher is better than lower. Leverage, higher is better than lower. Debt to equity, that is a matter of opinion. In my opinion, higher your debt to equity, the better, because you're leveraging your equity more. But some people like it to be within a sweet spot And so if it's not in that sweet spot, it could be bad, especially if it's over that sweet spot. And then current ratio, the more assets you have over your liabilities, the better. But not always, because you have a lot of live assets, and sometimes like cash, people want to either have that cash distributed or not, or invested in something like an asset or marketing or something like that. So you might find that people have a sweet spot as well for a current ratio. Anything above that represents under investment, under leadership or management of your assets. So you have to kind of keep that in mind. But usually a higher current ratio is better than lower. And gross margin and contribution higher is better than lower in general. So hopefully that gives you a little feel for what those should be. But the rest of these, you should be able to calculate based on our last assessment. The only one you might have a hard time with is contribution margin, but just think of it as gross margin, right? Taking this number, your total COGS, and subtracting out your variable. Did it say variable only? Oh, only include the variable. Sorry, I only include these portions. So you can just do a summary of these two divided by total revenue. Actually, revenue minus these two divided by revenue. Or that's generally what you're going to do. Just include that. These two, the summary of these minus, my gosh, I can't even speak. Revenue minus your variable cost of goods divided by revenue is your percentage. Do that for both of the years. That's generally what you're going to do there. So after that, you can actually use this to figure it out with your contribution margin. Do a calculation, right? This is where you figure out what your contribution margin is, which is your revenue minus your variable costs. You can figure out what your average daily sales are, your daily cost of goods. You can do any of those calculations here and reference them in your formulas up here. Other than that, I think that's pretty straightforward. Feel free to let me know if you have any questions. Bye.